All right, well, welcome back, everyone. Zach Potter, wealth advisor here at ARQ Wealth.
And Tristan Scheffler coming back with another video, a little bit more in depth, covering equity compensation. Specifically, going to cover RSUs and employer stock options, non-qualified stock options. Starting off with RSUs, so these are pretty common form today, right? Essentially, your employer's paying you an additional salary, but in stock instead of cash. This is very common, especially in tech companies. It's estimated about 70 to 90% chance if you work at a big tech company, you have RSUs.
So when you're, maybe working at this tech company, how do you get these RSUs, and what happens when you're given a RSU?
Yeah, so you're typically going to get a grant of a specific amount of shares. Like, just say, for example, you get a grant of 1,000 RSUs. You don't own those yet. That's where the name comes from, restricted stock units. They are restricted until you are vested. Now, you're typically going to have a certain vesting schedule that could be, a quarter a year over the next 4 years, equally over the next 3 years, whatever the employer determines. And vesting, right, what that really means is just it's the process of earning ownership of those shares. So as a portion vests, like for example, let's say the 1,000 over 3 years, after year one, you're vested to 333 shares. That means you outright own that portion. If you leave the employer after 1 year, you take those 333 shares with you. The remaining shares you don't own. They're still restricted, so those would stay unless you're with the employer until you're fully vested. So that is a big item that retains top employees, right? You could be leaving a lot of money on the table if you do leave with unvested shares.
And so on my vest date, in your example, I just get 333 shares deposited in a brokerage account?
Yeah, typically they're going to be, just in a brokerage account for you. Once you are vested, you can hold on to them, you can sell them, pretty much whatever you'd like. But the big impact there is taxes. When you're granted the shares, there's no tax up front because you don't own them. Once you're vested, and as you get vested to each tranche, those become taxable as ordinary income. So not capital gains rates, ordinary income. And that's because your employer is, again, paying you. They're just using a form of stock instead of cash.
Okay. And so with that, when they are vested, that's what determines that ordinary income amount, because it's going to be based on whatever the stock is trading at that day.
Exactly. The value of the stock when it's granted is irrelevant. It doesn't matter. The day you vest, the taxes are based on the fair market value of the stock that day. So if it's $100 a share, it's just $100 times however many shares you're vested to. That's taxable as ordinary income, will appear on your W-2. And then how the taxes actually work is kind of like a bonus tax as supplemental income. So the employer most of the time is going to withhold 22% for federal taxes, state taxes, and then FICA as well. Just to note that 22%, that's if your income is below $1 million. If it's over $1 million, they're actually going to bump that withholding up to 37%.
So I'm already kind of seeing a potential problem here. Like if I'm a high earner getting granted RSUs, but maybe my W-2 salary is not over that $1 million mark, they're only going to withhold 22%. But if I'm, again, a high earner in one of these tech companies, I might be in a higher tax bracket than that.
Yeah, exactly. So, like for example, if you're a single filer, you make $600,000-700,000, you're in the top tax bracket, 37%. They're just going to withhold 22% up front, and they typically do that just by withholding a portion of the shares. But the actual tax rate is going to depend on your marginal bracket. So in this example, 37%, you're under withholding by 15%. So it could create a surprise tax bill. If you're not on top of it, once you file your taxes, you're going to see the amount you owe. You could, of course, always make estimated quarterly payments, but really important to stay on top of these and track your overall income so you're aware of what taxes are actually going to come into play.
Yeah, so I do know I have a couple of clients that get these RSUs, and one strategy that we've taken is to adjust their normal paycheck withholding to account for some of that shortfall, so they don't end up underpaying like significantly, where you could run into different penalties or fees associated with that?
Yeah, you could definitely edit your normal withholding and essentially over withhold from your paycheck, just to increase overall withholding throughout the year. Another option is once you're vested, since you own the shares, you could always just sell them immediately to raise some cash for that tax bill. Important to note too, once you're vested, the day you vest, that starts the holding period to kind of differentiate between short-term gains and long-term gains. So as soon as you vest, if you sell it immediately, there's no additional taxes, right? Because you're going to be essentially selling it at the fair market value, which is the what the taxes are based off. So there won't be a gain, just the ordinary income taxes. So that's always an option. And of course, you could hold on to them, let them grow, wait until it's long term, and then obviously try to get a investment gain out of it. But that can create a large concentration in one company, right? And especially in your employer, that can be extra risky because a lot of people don't think about their companies going under, but it does happen, right? If we think back to like Enron, if you worked at Enron, not only did you lose all of your income, your source of your income, but if you had company stock, that's now all gone as well. So you don't want to have a lot of both assets and your income relying on one source.
Right. So it sounds like kind of with that concentrated position, especially through RSUs, you're saying my employment risk is with said company, my retirement outlook risk is with the same company, and so maybe diversifying when soon after or quickly after they're vested, you can avoid any kind of big capital gains and avoid creating that concentrated position.
Yeah, that's definitely a strategy we see pretty often. And, there's always a possibility too that you get vested to the shares at like an all-time high. If you think it's overvalued and can come down, I mean, you could always hold on to it for a little bit to see if you can get a loss out of it. Now, obviously, you're ending up with less cash in hand, but you do have capital loss, which you can use to either offset other gains or, the typical $3,000 can flow through to your tax return as well. But yeah, overall, it just creates a concentration risk if you do receive these and hold on to them, especially because you typically get more than one grant throughout your career, right? You may get a grant every couple of years. Mm-hmm. So from that first grant, it could take multiple years to vest, but in between the start point and being fully vested, you could get another grant.
I think I've seen that as well, where each year a client's gotten a grant of so many shares. And so, maybe that first year it was a small amount that was vesting, but now those grants have kind of piled up. And so now they're vesting, instead of maybe let's just say 5-6 shares at each quarter, it's 50-60 shares at each quarter.
Yeah, it can get pretty big. I mean, I personally have a couple clients who have RSUs that have been $50,000 a year that are vesting, and now even a little bit higher, closer to $70,000-$80,000 a year. So that's a lot of money to consider, right? One, just the additional ordinary income, what that's going to do tax wise, and then that'll quickly build up a concentrated position. If you're getting 50 plus grand a year in one stock, you're going to want to diversify out of it over time.
Absolutely. I think that's one of the reasons, if you're a person that receives equity compensation, can be a good idea to work with a qualified financial advisor. They can help you think through the tax impact of all of this, as well as the concentration risk, decide maybe how much you can keep in it without taking on too much risk, or if you should get out of everything immediately when they vest. So interesting stuff there. I know there's other forms of equity compensation. I think we were going to talk a little bit further about the non-qualified stock options. What's the difference there?
Yeah, so behind RSUs, non-qualified stock options are pretty much the second most common, but they work a little bit differently. If you're not familiar with options in general, basically you're getting the right to purchase the stock at a predetermined price. So how these work is you're also going to get a grant of a certain amount of options, stock options here, not actual shares. Now, the same thing, you do need to vest to those options. Once you are vested, that's when you have the right to buy the stock, again, at a certain price or what's called the strike price. So, for example, say you could be granted, again, we could use 1,000 shares vested over 3 years or 1,000 options. After year one, if you have 333 options vested, and by the way, once you get the grant, it's going to come with a strike price or an exercise price, which let's say for this example is $100. That's the price you can pay for it, regardless of where the actual stock price goes.
I'm going to stop there because one of the things I'm hearing, maybe a big difference, is like RSUs, that kind of happens automatically on the vest date. But with these non-qualified stock options, they're vested, and then that lets me decide when I want to exercise at that price, my strike price. But that also doesn't mean that that strike price lines up in any way with the current price of that stock. Am I getting that right?
Yeah, that's exactly right. And like you just mentioned, the biggest difference is with RSUs, you outright own shares as soon as you're vested. With stock options, you purely have the option to buy it. So again, for example, say they're granted with a $100 strike price. Well, once you're vested, if the price goes up to $150, you have a benefit there because you can purchase something at $100 that costs $150. So immediately you'd own those shares and you get a $50 gain, which is actually called the bargain element. Now, how the taxes work there in that same example, if it goes from 100 up to 150 and your strike price is 100, that $50 discount right there, that's the portion that's taxable. It's also taxable as ordinary income. Your employer could withhold at the same rates here, or you may just have to pay cash come tax time. So that's definitely something you need to be aware of, and the specific rules with your employer and withholding there. But on top of that, since you don't own the shares, you have the option to buy them, you still typically need to come out of pocket to pay for those shares. Now, some custodians that hold these options, they'll give you the option for a cashless exercise where essentially they're going to sell shares to raise the cash to buy the shares and then give you the net amount of shares. So you'd end up with a much smaller amount. So you don't always need to come up with the cash out of pocket, but again, you need to check the specific rules with the custodian on that. And a big negative compared to RSUs is if the price goes down when you're vested, right? So with the RSUs, since you outright own them, if they're granted at $100 and they go down to $50, yeah, you lost out there, but you still own the shares at $50. You still have some economic benefit. Whereas with the stock options, if you could buy it for $100, drops down to 50, you'd be crazy to pay $100 for something that costs 50. You would never exercise those options, and they're essentially worthless.
But with the exercising of those options, like once I've vested, I have the right to exercise X number of shares, I don't have to do that immediately.
No, you don't have to do it right away. You typically have 10 years from the date that they are vested, so you can hold on to them. They might ultimately be worth something, but as far as an immediate benefit like you'd have with RSUs, that just simply doesn't exist with the stock options.
So if you're granted those stock options, strike price $100 and it's trading at 50, you're obviously not going to exercise it there, but it is something where you can continue to hold those, and if the stock turns around, maybe it goes up to that 150 mark that we were talking about earlier, then you could exercise and still get that economic benefit.
Right. There's a little less certainty around it, right? You have to wait a little bit longer possibly and hope the stock would go back up. But ultimately there still could be some benefit. It's just not immediate and not certain. Although a benefit with them is your tax bill is likely going to be lower. Since you're not receiving shares outright, the full value is not taxable. It's just that bargain element or the discount you're paying that's seen as that's taxable as ordinary income.
So dependent on the strike price, where the stock is, again, that bargain element, depending how big that bargain element is, would tell us maybe how much more kind of tax planning we need to think about in withholding throughout the year.
Exactly. And something else to consider with the stock options is, like you mentioned, you don't need to exercise them right away. We have pretty much a 10-year time frame, but if you're going to exercise them, you don't need to exercise them all at once either. Like that could be a strategy to reduce your tax bill in one calendar year. You could exercise just a portion of them, say 25% of them, wait until the following year and continue to do that, assuming you stay within the 10-year period.
Again, more tax planning, because it could be, I'm expecting to be in a much lower tax situation next year. So I'm going to wait and I'll exercise a majority of them at that point, hoping to maybe mitigate some of my tax bill.
Right. With the RSUs, for example, it's a little bit of a double-edged sword. You hope the price goes up because you're getting, a bigger benefit, more income, but then the taxes are going up as well, which, that's a good problem to have, but a little bit more uncertainty around the tax picture until they're actually vested, because that vest date is what the taxes are based off of. But like we said, with the stock options, a little bit more flexibility around the timing and recognition of the income.
It sounds like with this equity compensation, a lot of planning opportunity, whether that be from a tax standpoint, the concentration risk, diversification, a lot of moving parts to make sure we're maximizing our strategies.
Yeah, 100%. And kind of going back to the example I was saying earlier of one of my clients who gets larger annual grants of RSUs. Well, as I also mentioned in the beginning, they're very common in technology companies, which their stock is naturally a lot more volatile. So in his example, he has, a pretty large amount of vested shares, pretty large amount of unvested shares. And over the last few years, from 2020 to now, there's been significant volatility both up and down. So some of the vested shares he's been locked into just big gains. We don't want to, sell them and realize more taxes. But with a consistent vesting and grant, he has a lot of shares that have caught in the downtrend in the market, and we've been kind of liquidating the ones at a loss, either just liquidating those outright, using losses for other areas, or liquidating the ones at a loss, using that loss to offset some of the RSUs at a gain. So kind of a wash there, but able to liquidate a larger amount and diversify more out of them. So like you said, a lot of tax planning opportunities around these.
It sounds like if you are a person that's entitled to different types of equity compensation, like we said, a lot of tax planning, a lot of financial planning opportunities in there. So if you are that person and you'd like to learn more about your options and maybe best way to handle some of these things, feel free to go to arcwealth.com, and then from there you're able to schedule a consultation. One of our advisors will be happy to sit down and see what we can help you with. Thank you guys all for watching today, and we will see you next time.
Thanks, guys.